5 cities, 5 completely different stories, same month. Toronto's recovering, Vancouver still dropping, Calgary's stuck, Edmonton's turning around, and Montreal's coasting along slow and steady. All of that is happening under the exact same national numbers, the same average price, the same overnight rate, the same headlines you see on the news. So, if you've picked just one of these headlines to base your next move, you could be making a very expensive mistake. Stick around because I'm going to break down what's exactly driving each one and which pattern matters most where you live. It starts with a number that sounds simple but hides almost everything worth knowing. Hi, Kane again. I struggled through theater school and I was a poor artist. 20 years later, I own real estate throughout Ontario. It came with a lot of hard work. Be sure to watch my biography video to see how I struggled. This video is for educational purposes only. If you are going to invest, be sure to speak with a licensed professional. Without further ado, let's get started. Take the number itself, 4.8 months of inventory nationally. If the whole country has only 4.8 months of inventory sitting on the market, why does a guy try to sell his Toronto condo feel like he's shouting into an empty room? The gap between national number and what people actually feel on the ground is where this whole story starts. Months of inventory sounds complicated, but it's simple. It just asks one question. If no new homes come into the market at all, how many months would it take to sell off everything that's completely listed at the same pace homes currently selling? Fewer months means buyers are snapping things up fast. More months means homes are piling up and nobody to buy them. Right now, the national number sits at 4.8 months, and that's actually below the pre-pandemic average of about 5.2. On paper, that looks tight, balanced, maybe even leaning towards sellers, and a realtor could show you that number and could say things are healthy across the board. But that single figure blends together two completely different words. One where sellers call the shots, and one where buyers hold all the power. Look at GTA condos, and you'll see the buyer side of that split. Active listings are climbing. New condo completions keep landing on the market in big waves, and investor demand has gone thin because math doesn't work anymore. So condo units just sit there, month after month, piling up on top of each other, and that pulls the average number away from what's really happening in that segment. Now, flip over to single-family homes in the same city, or head out to Calgary and story reverses completely. Supply stays tight, buyers are still competing, and homes move fast because there still aren't enough of them. Those fast-moving sales drag the national average back down, which is actually why countrywide numbers end up looking so calm and balanced when neither piece of it actually is. Blending property types into one national figure is like averaging the temperature of two homes, one freezing, one boiling, and telling someone the house sits on a comfortable 70 degrees. Technically true, completely useless. It tells you nothing about which room to walk into, and it tells you nothing about whether you should be buying a condo or detached home in July 2026. This is where the sales to new listings ratio earns its keep because it separates the seller's market from a buyer's market with way more precision than one blended inventory number ever could. Toronto's new listing dropped 17.8% in July, which sounds small until you realize that fewer homes coming onto the market combined with steady buyer activity is actually what tightens a market from the seller's ride. That ratio tells you something the 4.8 number can't. And that's where you end up with Toronto's posting 2 straight months for rising prices while Vancouver drops more than 6% year over year in the same country, under the exact same interest rate. Supply pressure is doing all the work here, not the rate environment. So, if the rate is identical everywhere, why does it produce such different results city by city? Because the same 2.25% is landing on 5 completely different housing markets, and what happens next depends on which one it lands on. The Bank of Canada has held its overnight rate at 2.25% for several meetings right now. That's the same rate whether you're a buyer in Calgary or a buyer in Vancouver walking into the exact same lender, filling out the exact same mortgage application. Why do these two numbers end up in completely different markets, one where homes fly off the shelf and one where they sit for months? The overnight rate is the price bank pays to borrow money from each other overnight, and it sets the floor for almost everything else in lending. When it moves, 5-year fixed mortgage rates tend to follow because those rates are produced off government bond yields, which react to where the markets think the overnight rate is headed. That's what turned a policy decision in Ottawa into an actual number on your mortgage statement, the payment you write off every single month for the next 5 years. Right now, 5-year fixed rates have eased off their early 2026 highs, with the lowest advertised rates sitting at around 4.09% in July. That's better than it was 6 months ago, but it's still well above what anyone got used to before the pandemic. Financing today is a little easier than it was a year ago. Call it relief, not a rescue. Here's the tension. If the rate is flat across the whole country, you'd expect buyers to behave roughly the same everywhere. They don't, because the rate is only one input, and local supply plus local job markets bend that same ratio into totally different results depending on where you're standing. Take Calgary and Edmonton, for example. Supply in Calgary has stayed tight, with new listings falling in 5 of the last 6 months and active listings down more than 4% from a year ago. Affordability there was never stretched anywhere close to what Ontario or BC buyers dealt with. When the rate eased even slightly, buyers showed up fast because they had room to move. Edmonton's following a similar path. Price still easing, but the trend is turning. Now look at Vancouver and the Fraser Valley. Same rate, same relief, completely different results. Prices there are still down more than 6% year over year, and resales fell again in July. The rate didn't fix anything because real problems isn't financing costs. It's that local income that never caught up to local prices in the first place. So you can shave half a point off a mortgage rate and still won't close a gap that big. Condos make this even clearer. The Toronto condo benchmark price is down around 7.4% year over year, while single-family homes in the same city barely moved, down only about 2%. The gap comes down to investor cash flow, plain and simple. Investors who bought units are now carrying higher costs while rents fall. National asking rents dropped to around $2,037, making the 22nd straight month of the year-over-year declines. Rent coming in doesn't cover the mortgage going out, so investors stop buying and a bunch of them start selling. The math creates a real opening. Oversupplied condo markets like the GTA have a buying window right now that doesn't exist in single-family homes because what's pushing condo prices down is structural, tied to a wave of completions, not something a rate cut alone fixes. CHMC already expects that pressure to ease by 2027 as those completions taper off and finally get absorbed. Which brings us back to the two numbers that started this whole video. Here's what actually matters. The national average, that $690,000 to $700,000 number, is real, and the 4.8 months of inventory is real too. But neither one tells you what's happening on your actual street. Check local sales to new listings ratio and local inventory broken out by property type before you make any move. If you're in Ontario or BC, look at condo completions in your city first. If you're in the prairies or Atlantic Canada, don't let national weakness headlines scare you off because your local supply story might be completely different. One rate is sitting on 6 supply stories, and that split holds well in 2027. If you've enjoyed this video, be sure to watch my next one on how rich families protect their wealth. Thanks for watching.